Investing in IPOs can be tricky business, and if investors are not mindful, then following a trend may result in losses. Given that Indian retail investors are young and new to the capital market, they must understand what it means to invest in an IPO. Doing a bit of your research can take an investor towards making profit in the market. This year 2021 has been really special as we witnessed new age technology startups like Zomato, paytm, nykaa, etc. hitting the stock market. In 12 months, the IPO market had 53 IPOs and collected over 1 lakh crores. Investing only because the company name is well known can be dangerous. There are many other factors that can make the company worthy or unworthy of investment or not. To be an informed investor, you should do your own research, and here are some pointers that could help you. Business model. Before you decide to invest in an IPO of a company, you need to analyze the business model of the company you are considering. Understand how the company is generating revenues, its cost structure, products and services. If the company seems good based on the business model, then you can go to the next level. Financial track record. Check how the company has been performing and if generating profit in the last 5 to 6 years or not. Look out for the growth in its sales and revenues. Profit and growth indicates that the company is stable, and this makes investing in such companies profitable. If the company has been inconsistent with its profit and growth in the past 5 years, then you need to be careful since you can't rely on inconsistent number for profitability. Management. After you have analyzed its business model and financial track record, you may also want to look at its management. Take a close look at the people running the company, including the promoters and the company's management team. You will have to see whether these people have enough experience to run the business or not. This is also important to assess that the company is credible and there is no history of scams and litigation cases. Valuation. Once you have checked the business model, history and the management of the company, it's time to see the valuation. There are a lot of valuation methods like price to earning, enterprise value to sale, price to value, etc. When a company demonstrates high PE ratio, it means that either the company is overvalued or is on trajectory to growth. Another interpretation of high PE ratio could be that such a company is expected to have increased revenue in the future, and speculation of the same by analysts and investors has led to a surge in the current stock price. On the other hand, a low price to earning ratio signifies undervaluation of stocks due to any systematic or unsystematic risk of the market. Considering a different interpretation of a low PE ratio, it would also signify that the company shall perform poorly in the future, due to which its stock price are falling in the present. So, before you consider investing in any IPO, look out for these 4 important pointers: business model, financial track record, management, valuation. Tell us if this has been useful to you. Share your thoughts and the feedback in the comment section below. We would love to hear from you. Visit the blog section in our website www.tradeplusonline.com/blogs for info on every IPO and daily market updates. Download the Rocket app on your mobile to check current market updates, watch list and market happenings. Follow us on social for weekly market trigger and wrap up, IPO updates and the latest news about the stock market. And don't forget to like, share, subscribe to this channel.